Hey everyone, welcome back to Corporate Decoder. Today we are diving into a report that's all about bonds, specifically energy transition bonds. Don't let the name fool you. We'll be breaking down what they are, why a power company called Cleco is issuing them, and what it all means for the future of energy, or at least for Cleco's future. Are these bonds a bright idea or a potential financial hazard? Stick around to find out. So, on March 5, 2025, Cleco Power, which is the company actually making electricity, and Cleco Securitization II LLC, which is a separate company created just to issue these bonds, got into an agreement with some big banks. These banks, JP Morgan Securities and SMBC Nikko Securities America, are helping Cleco sell these bonds. What exactly are they selling? Well, the report says they're selling $305 million worth of something called Series 2025, a senior secured energy transition bonds. Basically, Cleco is borrowing $305 million from investors, and they promise to pay it back later with interest. These bonds are secured, meaning that if Cleco can't pay, the bondholders have a claim on some of Cleco's assets. These are energy transition bonds because the money raised is supposed to be used for projects that help Cleco move towards cleaner energy sources. Now, to make this bond deal official, there are a bunch of legal documents involved. These include something called an indenture and a series supplement. Think of the indenture as the main contract for the bonds, setting out all the rules and promises. The series supplement is like an add-on that specifies the details for this particular series of bonds. To convince investors to buy these bonds, Cleco created a prospectus, which is like a sales brochure for the bonds and was published on March 5, 2025. It tells investors everything they need to know about the bonds, the risks involved, and how Cleco plans to use the money. But wait, there's more! Besides the bonds themselves, Cleco is also entering into a bunch of other agreements to make this whole thing work. These include an energy transition property servicing agreement, which is all about how Cleco will manage the assets related to these energy transition projects. There's also an energy transition property sale agreement, which might involve selling some of Cleco's assets to this special company to back the bonds. Plus, there's an administration agreement, basically stating how Cleco will handle all the paperwork and behind-the-scenes stuff for the bonds. And finally, an intercreditor agreement, which is just a fancy way of saying an agreement between all the different companies that have a stake in this deal, making sure everyone knows who gets paid first if things go south. Exhibit 1.1 is the underwriting agreement. This agreement outlines all the details of how JP Morgan and SMBC Nikko Securities will help Cleco sell these energy transition bonds. It covers things like how much the banks will get paid and what happens if the deal falls apart. Exhibit 4.1 is the indenture. Remember, this is the main contract for the bonds, setting out all the rules and promises. It's between Cleco Securitization II LLC and the Bank of New York Mellon Trust Company, which acts as a trustee, meaning it looks out for the interests of the bondholders. This exhibit also includes the form of the energy transition bonds themselves and the series supplement, which adds specific details for this particular series of bonds. Exhibit 10.1 is the Energy Transition Property Servicing Agreement. This agreement is all about how Cleco will manage the assets related to these energy transition projects. It's between Cleco Securitization II LLC and Cleco Power LLC, with Cleco Power acting as the servicer, meaning it's responsible for managing the assets and making sure everything runs smoothly. Exhibit 10.2 is the Energy Transition Property Sale Agreement. This agreement might involve Cleco selling some of its assets to Cleco Securitization II LLC to back the bonds. It's between Cleco Securitization II LLC and Cleco Power LLC, with Cleco Power acting as the seller. Exhibit 10.3 is the administration agreement. This agreement is about how Cleco will handle all the paperwork and behind-the-scenes stuff for the bonds. It's between Cleco Securitization II LLC and Cleco Power LLC, with Cleco Power acting as the administrator. Exhibit 10.4 is the intercreditor agreement. This agreement is between all the different companies that have a stake in this deal, making sure everyone knows who gets paid first if things go south. It involves Cleco Securitization II LLC, Cleco Power LLC, Cleco Securitization II LLC, and the Bank of New York Mellon Trust Company. So, what does all of this mean? Cleco is essentially betting on the future of clean energy. They're borrowing a lot of money to invest in projects that they hope will pay off in the long run. This has several implications. First, it allows Cleco to upgrade its energy infrastructure, potentially reducing its carbon footprint and appealing to environmentally conscious investors. Second, it could reduce future energy costs by investing in renewable energy, creating more energy security. Third, it improves Cleco's image as a forward-looking company, attracting a new segment of customers and investors. However, the risks are substantial. First, Cleco is taking on a massive debt of $305 million, which could strain its finances if the energy transition projects don't perform as expected. Second, the regulatory environment for clean energy can change, potentially making these projects less profitable. Third, there's always the risk that new technologies will emerge that make Cleco's investments obsolete. Cleco appears to be trying to position itself as a leader in the energy transition. However, it is taking a huge gamble with $305 million. It's a bold move, but whether it pays off remains to be seen. It will depend on how well Cleco manages these projects and how the energy market changes over the next few years. Thanks for watching. If you enjoyed, please subscribe, like, and comment.